Well, I don't know if you read my mind or you saw the notes on my page here, but depreciation recapture is the part of it that makes me nervous because I am always, and this might be my legal mind as an attorney, if then scenarios, right? Like I think my day is broken up like that a lot. Because there's no one size fits all. And I think that's the same for cost segregation based on our conversation. And so if I have the potential of, well, if I need to exit a particular property, let's say I need to create some liquidity in a quick manner, that's always the risk to me. So talk to me about depreciation recapture. Let's go high level with it, and then I'll bring us a little deeper in some of the sections. But when we talk about depreciation recapture, am I just going to get hit with a ginormous tax bill when I go to sell this thing, maximum tax bracket? It's literally going to be at my income level. What am I looking at there?
Yeah, and it's a really important point you brought up, and I'm glad you did, because let's start first with what it isn't. Okay, because I think a lot of people have misconceptions based on my reading forum posts and Bigger Pockets and questions I get from investors all the time. There is a big misnomer of what depreciation recapture is. So let's stuff what it is not. Okay, it does not mean that you have to pay back all of the depreciation that you took. So if you take $300,000 of depreciation deductions over the course of ownership, when you sell, you're going to have to pay now $300,000 back. That is not what it means. Okay, so let's just be clear about that. And you see this all the time. You go search Bigger Pockets, for example, depreciation recapture means you have to pay it back when you sell. It does not mean that. It's really wrong and misguided. What it does mean is that depreciation recapture is considered a gain, like a capital gain. Okay, so it's called an unrealized gain. When you sell a property, everyone understands there's something called capital gain tax, which means if you made a profit on the sale, you now are going to be taxed on that profit, that amount of profit. And capital gains can be taxed at 20%, 25%, whatever those rates are, varies federal, state. Depreciation recapture is an unrealized gain. So the amount of depreciation that you took during the course of ownership, you're going to be subject to a tax on that amount. That tax rate, however, is going to depend on several factors. Okay, there's actually 3 different rates that this can be that we can tax this on. And I'm not going to get into the details of that. It's a little more complicated, but essentially it is either capped at a 25% rate, which is similar to capital gain, or there is a certain amount that can be applied to a ordinary income tax rate, whatever that is. And so there are going to be different values. So when you do a cost segregation, taking more depreciation up front, that means you're going to have a larger bill on the sale. Okay, that's recapture tax in a nutshell. However, and I do want to kind of bring this however in there, because based on your question, Justin, you're like, well, what do I do if I have a sale? I want to dispose of property. What am I going to do? Is this something I should factor in? It is very much something you should factor in. However, you should also factor in the other things that can help you in terms of making sure to plan accordingly. And this is something, again, I'm not, your CPA. This is something you should discuss with everyone listening out there, discuss with your own tax advisor, right? This is not, direct advice to you, but that's our disclaimer. But what you do need to understand is 2 things. Recapture tax, along with capital gain tax, can be deferred with what's called a 1031 exchange.